Hello everyone, friends. Today we have our first lesson on trading. Let's get started. Let's go. Today we'll break down the imbalance formation and its key variations. Let's start with the basics. Fair whale gap or fair value gap. This is a 3-candle pattern that shows a mismatch between supply and demand. At the moment of formation, buyers were so dominant that at certain prices there simply weren't any sellers. Because of this, the price seemed to jump over a range. The unfilled demand remains in this zone in the form of limit orders. The market tends to return to this area to complete the exchange and allow participants to fill orders at those prices. A bullish imbalance is defined from the high of the first candle to the low of the third. It's important that both candles are closed. Only then is the pattern considered valid. Here, we see the opposite situation, a bearish imbalance indicating aggressive selling by large players and a lack of counter demand. If the low of the first candle had been slightly lower and the high of the third slightly higher, we would have had efficient price formation within the range, with both buyers and sellers present, creating equilibrium. This is exactly the kind of structure all algorithms strive for. How is imbalance used? It has two functions. It attracts the price and serves as a support zone. This means the market will tend to gravitate toward this area and is highly likely to react after it is filled. This happens because imbalance is formed at the moment when smart money is taking active action. Therefore, a reaction from this zone shows their interest and confirms price support. A position is most often open from the beginning of the imbalance. A protective stop is placed below the first candle of the formation and an aggressive stop below the second. Take profit in this example is at a risk-reward ratio of 1:2. Now let's move on to how to use imbalance in a real market situation. First, the context. The price was in a range and the upper boundary was taken out. This is a deviation. The reversal happened after the imbalance was completely filled, which became the starting point for the downward movement. Now the lower boundary of the range is our global target, and the fulfillment level acts as the first support. Next, a bearish imbalance forms, which we use to enter a short position. It indicates pressure from large sellers, so it makes sense to expect the price to continue moving down until the lower boundary of the range is taken out. Entry is from the start of the imbalance. A conservative stop is set above the high of the first candle. This is the level after which the scenario is no longer valid. The first take profit is at the lower boundary of the range, where we lock in at least 50% of the position. The second take profit is at the next significant level below. The price triggers the trade, but a bullish imbalance forms nearby. The high of the first candle, the low of the third. The question arises, will we see a rise from it? If that happens, the stop loss will be triggered. Should we close the position in advance? No, this does not change the main scenario. The market is aiming for the lower boundary of the range. All intermediate support zones, including this bullish gap, will be broken through amid the downward flow of orders. It's important to separate the secondary from the main. A bullish imbalance is replaced by a bearish one, and given the prevailing downward order flow, you can also consider entering from it. We open from the start of the gap, set the stop behind the first candle, and take profits at the previously indicated levels. The risk-reward ratio comes out to 4.15, almost the same as in the first scenario. The limit order was filled, the price lingered a bit inside the zone, which is normal, and then the decline continued. Another bearish imbalance appears, which we use according to the same model. After a partial fill, the price reacted and reached the targets. Both positions worked out. The move from the previous high to the current low is a great example of a downward order flow, and how many opportunities the market offers if you understand the basic mechanics of price delivery. Now let's move on to BC and CB. These are still imbalances but of a more refined type. BC is a bullish gap, while CB is a bearish one. So these terms refer to areas where either buyers or sellers dominated. Now let's look at the key levels within an imbalance and the correct reactions to them. The first level is the start of the gap. The ideal reaction is a touch with a close above. I use this most often as a basic entry point because this level provides a guaranteed opportunity to enter a trade. Next is the 50% mark. This is considered a fair price within the imbalance. The price often gravitates toward it since counter liquidity appears here. This is what's needed before the movement continues. If the reaction is strong, the zone is considered balanced. A candle body closing inside the zone is a healthy reaction, so a close below the 0.5 level indicates weakness. But this does not invalidate the break itself. It only increases the likelihood of it being fully filled. true invalidation occurs after the low of the first candle is taken out. The final level is a full fill. It doesn't occur very often, but mainly in the early stages of a reversal or a range. This is quite rare during trends. A full fill erases the traces of the impulse, making the chart visually balanced. After this, smart money can initiate a new impulse without the risk of a premature counter reaction. It's important to me that the candle body closes above the 0.5 level because this shows a correct market response and increases the chances of further growth. If the close is below 0.5 or the full fill, then the probability of growth decreases. Often, this is a signal of a weakening impulse and the potential for a decline to the local minimum. These were the trigger levels within the imbalance. Now let's look at their pros and cons. Now, for example, the price is moving in a downward order flow. A new bearish imbalance is a strong resistance and acts as a magnet from which we look for shorts. Below, the bullish gap hasn't been filled by 50%, which means it remains as support and pulls the price. In addition, the weekly imbalance was confirmed from the start of the week. Its beginning becomes a key target. The first position is an entry from the start of the gap. Our RR is 1 to 2.17. If you don't like that RR, look at the 50% level. There it's about 1 to 2.5. The third option is a full fill, where the RR is the best. The price gives a clear reaction after filling the zone and can't hold above it. This is a signal of readiness for further decline. The candle's wick creates an order block on the lower time frame. From there, a conservative entry is possible with a stop above the high. The next target is the IFVG. This is an inverted fire weld gap. This is a situation where the imbalance changes its purpose. For example, the BC was resistance, but after the bullish candle closed above the fulfillment, the structure changes polarity and becomes support. The IFVG works to continue the trend. After confirmation on this candle, we wait for a correction and further growth. Although the entire IFVG area acts as support, the main focus is on the 50% level, which is where the entry is made. On the right is a bearish IFVG. The BC area becomes resistance because the price closed below the fulfillment with the candle body. After the pattern is confirmed on the next candle, there is a correction to the 50% level and the decline continues. It's important to understand here that the inversion of BC usually happens without the appearance of a new CB. It can happen even in an efficient structure, as shown in this diagram. Now, a real example. Two imbalances are marked. We watch the price reaction and consider the trading logic for trend reversals. The price completely fills the BC and closes the candle body below 0.5. This shows the weakness of the asset and the likelihood of the downward movement continuing. The zone changes polarity and turns from support into resistance. We wait for a correction to the 50% level and then a drop. Note, a CB does not appear where the BC was, but this still doesn't prevent us from using the zone as resistance. This is the essence of IFVG. After the correction, a reaction occurs and the price continues to move. The next BC area is also inverted after closing below the full fill. And again, a CB does not form. This is already normal. The next type is BPR. This is a balanced price range. A bullish BPR is formed when two opposite imbalances CB and BC intersect. It helps to refine the area of interest. We expect a correction at least to the start of the BPR, not to the start of the BC or the 50% mark. The second advantage of the BPR is that it creates a stronger support zone. However, the stop loss is still set according to the 3-hour BC structure behind the low of the second candle. That's if you're being aggressive, or behind the first candle if you're being more conservative. On the right is a bearish BPR where a CB forms in place of the BC, and their overlap acts as a magnet and resistance. Here's an example of a bullish BPR, from which we expect a correction and then continued growth. A bearish BPR is the first zone where it makes sense to take profits. Notice how much the working area becomes more compact. Instead of a wide imbalance, we get a precise core of the area of interest. Enter a long from the start of the BPR. Set your stop behind the second imbalance candle and take profit at the start of the bearish BPR. The risk-reward ratio comes out to 1 to 5.5. The price reaches the zone perfectly and shows a reaction. BPR strengthens the structure, refines entries, and helps determine targets. The last form of inefficiency is volume imbalance and gap. In the first situation, a gap appears between the close and open of the candles, but the wicks overlap. This acts as both a magnet and resistance. We wait for a move to 0.5 and then for the decline to continue. The principle is identical to the classic imbalance. A bullish volume imbalance acts as support. We expect a correction and then continued growth. A gap differs in that the wicks do not overlap at all. The range is set by the bodies from the close of the first candle to the open of the second. It is incorrect to define a gap by the wicks. We wait for it to be at least partially filled and then for the movement to continue. This is a magnet and a resistance zone. In a rising market, it acts as support. Below are examples of how they form. Resistance zones are marked in orange and support zones in gray. These types of inefficiencies are found in traditional markets. For example, Bitcoin and Ethereum futures on the CME regularly form volume imbalances and gaps. They can be taken into account to improve analysis accuracy. This is a chart of the Bitcoin futures on the CME. Here, a gap is marked that appeared between the close and the opening of the next day. Already on the next candle, the market reacted and the growth continued. Next is the volume imbalance. The next day, the price completely filled it and then moved up again. Another volume imbalance was balanced during the formation of this swing. The operating principle is identical to the classic imbalance. The market strives to fill all the gaps. Friends, all the broker links are in the description below this video. Be sure to check them out, register, and of course subscribe to this channel as well. See you in the next video.